The fallout from Washington's inability to find a solution to the budget crisis and raise the debt limit has apparently begun. On Wall Street, the stock market was down for the third day in a row. The Dow fell more than 198 points today. For the week, it's down nearly 400 points and has lost close to $105 billion in value. Some of the bond rating services are now saying that even if Congress does reach an agreement on a budget plan, it may be too late to avoid lowering the rating on some American securities. We have 3 reports tonight on that and what it means for small business and your credit card. And we start with Anthony Mason. Anthony?
Bob, America's credit rating has never fallen below AAA, but with Washington looking increasingly dysfunctional, economists now see the threat of a downgrade as high and rising.
Do you honestly believe that the United States could default on its debt?
In Washington today, the head of Standard & Poor's told Congress his rating agency is worried about more than just raising the debt ceiling.
The main, more important issue is really the long-term growth rate of the debt.
Now at more than $14 trillion and rising, U.S. debt as a percentage of GDP ranks 5th highest in the world. Even if a deal emerges to raise the debt ceiling, it may not be enough for the ratings agencies.
Is there still a risk that the U.S. credit may get downgraded anyway?
Well, it looks like that.
But Larry Cantor, chief of research at Barclays Capital, believes the world will still want to invest in the U.S.
Even if they downgrade it, people still believe that the U.S. will pay its debts.
But a cut in the credit rating could still have expensive consequences, says economist Michael Darda.
The risk would be that a downgrade would push up interest rates.
That could add as much as $100 billion to the nation's annual borrowing costs. It would also raise the cost of mortgages and other consumer loans. Countries with AAA ratings, on average, pay just below 3% to borrow. Countries with a AA rating pay 3/4 of a point more. There are exceptions. Japan's rating was downgraded to AA, but because of a stagnant economy, it still pays a lower interest rate than the United States.
But a debt downgrade certainly doesn't help things. I mean, at a minimum, it throws an added element of uncertainty into the mix at an already uncertain time.
The rating agencies say there is no specific timetable. The decision on whether to downgrade will depend on events. Standard & Poor's has already stated there is at least a 50% chance the credit rating of the U.S. will be cut. Bob?
Well, Anthony, what do you think the chances are that we may just slide into another recession here?
I don't think a downgrade itself will cause a recession, Bob. But if the government is forced to shut down because the debt ceiling isn't raised, I think we could end up back in a recession, and very quickly.
All right. Well, thank you. Thank you, Anthony.